Welcome, everybody, to a new episode. In a world of constant market shifts and economic uncertainty, understanding how to adapt your investment approach is more crucial than ever. In this episode, we'll explore recent trends, discuss how to really spot opportunities amongst volatility, and learn the secrets of building a resilient portfolio in the long haul. Joining us today is our guest, Shane Thomas, the managing director and co-founder of Catalyst Equity Partners. Welcome, Shane.
Hey, Nathan. Excited to be here and look forward to the conversation.
Likewise. So, let's dive into it. Can you tell us a little bit about your history, your story, how kind of Catalyst Equity Partners came to be, and kind of what your background is?
Yeah, I'll try to give the short version. So I'm educated as a CPA, worked in public accounting and consulting for about 10 years, but had always had the real estate bug. So I bought a few single families in 2010 in Canada, where I'm from. And then I moved to the US in 2010 for a job and kind of put my head down. 2010 kind of was the depths of the last recession. I was getting a job when a lot of people were struggling in the US. So I just put my head down and worked for 5 years straight, and then came to a point in my life where I just got married, planned to have kids, and was like, was kind of on that track, climbing the corporate ladder. And I had to kind of make a decision at that time. And real estate had done well for me in Canada and kind of saw an opportunity in the US. So long story short, at that point in time, I decided that I wanted to get into, US real estate. And being a finance guy by trade, really, multifamily and commercial real estate really resonated with me, given that valuations based on income versus single family, you're kind of more at the kind of mercy of the market. So in 2014, 2015, started going down the path to buy my own 20 unit. And then fast forward, kind of long story short, that didn't work out. And I think it was in some ways a blessing in disguise. Stumbled across syndication in early 2015. Met a few guys that were doing it in Texas. I was living in Chicago at the time, and started investing passively. So I invested in a few deals as a passive investor in 2015 into 2016. And then, what you learn, I'm sure that you guys have covered in your, other podcasts, is as a passive, you get to see a little bit under the hood. So I was able to kind of see things that I liked about how things were operating and what I didn't like. And then I, really kind of after a year or so of passively investing, I said, you know what, I think I have the skill set. And then I met my now business partner in 2016, and we had no intent to really partner. We just kind of became peers, and we kind of had the same goals. He came from a different, path and whatnot, and, a friendship brewed. And kind of 9 months later, we were looking at deals together, and ended up getting our first deal closed in Houston, Texas. That's where I'm based. My partner's based in Dallas. Our deals are, split between the two markets. So since, 2016 through now, we've done about 2,000 units as lead GPs. And we've done everything from Class C, value add, hairy multifamily, to we've got a few kind of Class A minus deals, 2015 vintage. We have a construction company that we started a couple of years ago, mainly for in-house. And then, last year we pivoted to do third party on that. So that's been a good pivot. And we've got a small team. We don't do property management in-house yet. But yeah, that's kind of our story. We've got about 7 folks full time, and value add multifamily is our bread and butter.
Man, oh, very similar story to kind of Vic and Robbie. They, started off as two hospitalists, so to speak, that were kind of bumping shoulders, and then eventually became friends and started talking real estate, and then went into the syndication realm and kind of started to scale. So very similar stories there. Yeah, I know we're going to be talking a lot about markets today and the dynamics there, but it's interesting to see someone who's kind of spanned Canadian markets, American markets, new construction, value adds, C deals, A deals, and kind of had that whole breadth of experience. Just out of curiosity, what kind of, if any, are there any differences between Canadian real estate market and the US market?
Yeah, that's a great question. And I would say there's probably two main differences that I see. I think maybe the first one is there's no country that I'm aware of that has a 30-year fixed mortgage outside of the United States. So in Canada, they're usually 5-year terms, and, people are resetting into high interest rates right now. So that's an issue. So I think that's one benefit, that if you're a US real estate investor, that's one benefit that we have worldwide over folks. And the second thing is, in Canada, there's a lot more condos than apartments, right? So you don't see apartments, but you don't see, a lot of garden style, massive complexes with low density. You don't see that in Canada, right? So it's very hard in some ways. I was actually just in Canada for a summer trip, and it's a little harder to explain what we do because when people think apartments, they relate it to condos in Canada. So I'm from Toronto, and there's a condo boom there. And so yeah, it's just not as prevalent as what we have in the US. And as I understand it, I mean, most of the world doesn't have, apartments as we do, right? And so I think those are the two big things that stand out. And the last thing I'll say is Canada has a huge housing shortage. There's an immigration boom there. I read a stat that multifamily vacancy rate, was expanding to 1.5% vacancy. There's no inventory there. And a lot of the provinces have rent control and whatnot, but it's a very tight market. They need a lot more housing.
Yeah. Fascinating. Fascinating. So let's dive into it. What if there are investors out there that are trying to interpret the market? What kind of signals should they be looking out for? What kind of, leading versus lagging indicators are you guys paying attention to? Because really ultimately the idea there is, we want to predict the market. Ultimately, if you got a crystal ball and know what's kind of coming down the pipeline, you can really kind of position yourself well. And ultimately, I'm sure, Catalyst is similar to Viking, where we're trying to buy in all market cycles, or we're not trying to time the market and only buy when pricing's low, right? So kind of curious as to what, kind of indicators you're paying attention to.
Yeah. I think I'll answer that question by starting with, look, like you said, right? There's no way to really time the market perfectly, right? When I started in 2015, 2016, a lot of folks at that time were saying, oh, the market's overpriced, and we had just come out of the recession. And, a lot of those folks, were on the sidelines and missed, a big upcycle. Sure, we're in a down cycle now, but so I agree with you. You got to be in the game always, right? That doesn't mean you got to force deals, but you got to be in the game always to kind of see which way the wind's blowing. And so, it's very clear right now, especially if you rewind from 2 years ago to now that, obviously, rents have flattened, if not decreased, right? There's a big supply wave that we're facing right now. So, and valuations have come down from the peak, right? Because there was the COVID boom where interest rates dropped to nothing, and cap rates compressed, and there was a lot of I would say kind of irrational exuberance, right, in some cases. But if you kind of have a long-term plan, I think you'll be fine. Right now, in terms of signals, right, I think the reality is that from March 2022, the Fed, started raising rates at an unprecedented rate, right? 40 in the last 40 years, we haven't seen this speed. And, they weren't going like 25 basis points at a time, right? It was 75 basis points, right? And so, there was just a lot of uncertainty, right? And, I was in New York, talking to some private equity and stuff like that. And I was asking the same question, like, what signals do you guys, when do you know it's go time, And I think it's more about clarity than anything else, right? I think right now what we see, and we're selling a deal right now, we've owned for a long time, still in the money, but like you could see that there's a little bit of kind of clarity or stability in the market, right? So like the Fed has come out and say, hey, we're no longer raising rates. They haven't said they're going to go cut, but I think that's leveling the playing field. And, it's giving real estate investors like, hey, at least I know what the rules are to play by, right?
Yep.
So whereas 18 months ago, we didn't know, right? And so I think we're looking at, we are looking at supply. I mean, we've always looked at supply. And if you read the headlines right now, I mean, I think there's been like 250,000 completions this year alone. We're just over halfway done the year, right? And I think we're on track for 600,000 nationally, right? Whereas if you look at the last 2-decade average, it's like just over 200,000, right? So definitely we're seeing a lot of supply, but it makes sense because in 2021, 2022, when interest rates were low, everyone's like, hey, let's go build, right? And cap rates had compressed. A lot of people didn't feel like it made sense to go. I could go build it for cheaper than I'm buying it, right? Replacement cost story. And so, we're looking at, but on the flip side, there's nothing starting right now, right? So we have the conviction that, in 18 months from now, we should see supply drop. There's still demand in the markets that we're looking at, and we should see some rent growth, right? But I think short term, basis wise, I've seen deals. I haven't seen deals priced this way since 2018, right? Like we're seeing C deals, which is not something that we generally look at these days, but we're seeing them at over 7 cap, right? And we are seeing 5.5% interest rates. That's positive leverage. And I think finally we're starting to see, risk being priced in. And, versus I saw a lot of C deals in the last 3 years being bought at 4 caps,
Yep. Yep.
And so we're seeing some of that. We're seeing opportunity there. And, I think right now, basis wise, it's probably one of the best times that I've seen since I started in 2015. That said, the next 2 years are really tough to underwrite, right? Because you have this supply, it's really hard to model rent growth. And, what we've done is we've just like told our investors that we got to really, retrain our brains, right? Because I think we've always been long-term holders. We've always tried 5-6 year holds. But I think what happened is that as a GP or LP, the last, call it 7 years, there's been a lot of 2 year flips, 3 year flips, and that was never the intent. And I think we have to retrain our brain that real estate is a long-term wealth creation vehicle, right? 5 to 10 years, right? And so that's what we've been doing. But I think the fact that interest rates are the Fed has said they're no longer going up gives us clarity. And then, we've seen signals like Blackstone and whatnot, and KKR buying these big portfolios. I mean, I would say, for them, it's obviously different. They've got to deploy money. But I think those are, kind of some signals that the tide could be turning.
Yep. Yep. I love it. I mean, you touched on a lot, right? I think it all comes back down to the supply and dynamics that you were talking about earlier, right? Ultimately, you have all this demand, you have the supply that tries to fill the demand, and then you kind of have that cycle restart. Same thing on the data things too, but really being in the game, at least for us, really allows us to have kind of a real-time pulse check on the market. Whereas if you're reading these reports that are coming out, in quarters after the actual data hits, you're kind of already behind the ball if you're just relying on that data alone. You talked about really kind of being able to pinpoint when, assets are good play or when it's kind of a good time to buy. How do you know when, an asset is undervalued given kind of the current market dynamics that you're in?
Yeah, I mean, that's a great question. I mean, I think the way we look at newer deals is, if we look at the replacement cost story, right? I mean, right now, I mean, I think you can, and 3 years ago, this wasn't the case, but we're seeing deals like 2020 build, 2022 build, 2018 build that you could buy at 20 to 30% below replacement costs, right? So that right there inherently is intrinsic value, right? So that's one way we look at newer deals. On the older deals, I don't like the replacement costs kind of analysis there. I mean, these deals are way too old. I mean, maybe if you look at it from a land value, but on the older deals, we look at it from yield relative to the risk. And so when I first started buying, multifamily in 2016, I mean, legit, my first deal was almost a 9 cap. And so at that point in time, we're like, hey, 9 cap, I think we were at 6% interest rates then. There was enough arbitrage there to take on that risk, And so today, what we're seeing is like Class A deals or pricing around 5.5 cap in the markets that we're looking at. They feel to be kind of sticky there. We went from 4 caps to 5.5 caps in the last 20 months as interest rates rose. And I think C deals have finally got replaced where we're at 4.5 cap, right? I think a lot of people were there was almost no difference or arbitrage between a Class A and C, and people were banking on rent growth. And now we're seeing Class C deals, like I mentioned, gap out to 7%, right? And so that's how I look at it. And then we look at, just relative price per door, right? Like price per square foot. What's the dirt worth? What's the bricks and sticks worth? And to us, I mean, we're seeing pricing in the I would say 2 years pre-COVID era for some of the older stuff,
Yep.
And the reality is like, there's always going to be demand for workforce housing. I think where, a lot of people have got snake bitten with the C stuff is, these deals are old, right? I mean, 40, 50, 60 years old. in the South, they weren't built like some of the stuff in the Northeast and but you have to have the right capital plan. I think what's happened is a lot of the C stuff, people come in with like 3-year business plans and then they run out of money and then can't sell, right? Those are where you get hurt. But if you can find well-located Class C deals with good bones, I think there's always demand for it, but you got the right price,
Yeah. Yeah.
that's the key. Yeah.
Yeah. And to your point too, right? Like there was a time when cap rates weren't really pricing in the risk, right? Debt was cheap. So people were willing to pay whatever cap rate because you can get 3% debt
Yes.
until that debt started to rise. And then you're put in severely, negatively leveraged situations.
Yeah.
So I agree with you. I think right now we're kind of some stability come back in the market with rates kind of staying sticky at kind of where they are. And with that stability brought a little bit more clarity to saying, hey, cap rates are now actually, what properties should be valued at.
Yes.
And that's kind of tough with what went on kind of a couple years ago where we had, astronomical pricing. It's tough to pull comps from a year or even 2 years ago because pricing was at kind of an all-time high,
Yes. Yeah.
Can you talk, a little bit about the current kind of state of the market? Let's say there's a new investor who's kind of new to multifamily. They're thinking of doing their first passive investment. What's going on in the market? What kind of challenges are there? What kind of opportunities are there? And then kind of what does the next, 12 to 24 months look like?
Yeah, yeah, great question. And what I would say, if you're a brand new passive investor, I mean, this time to enter is probably one of the best times that I've seen in my 8-year career, right? And I know that's, maybe surprising to say because, a lot of investors in the last couple of years that got in 21, 22, the results may have not been what they expected, right? Because interest rates have risen, distributions have been paused, there's been capital calls, and there's been deals that have went back to the bank, right? But I think right now is a great time to enter, right? And especially if you don't have that baggage, you could come in with a fresh view and say, am I buying, like what's the long-term horizon on this investment, So I think now is one of the best times as a passive investor. Comes down to education. And I think it comes down to long-term expectations, right? In 21, 22, a lot of folks got in because they saw the quick turns and multiples, right? I firmly believe, I mean, like, this down cycle has been 2 years and we'll see how long it takes to kind of get out. But I would say you're in this for 5 to 7 years on new deals right now, and my philosophy is that if you are able to kind of see that far, and have that patience, I think you will be rewarded well, by investing now, right? Short term, it might be tough. But I think long term right now, and look, at the end of the day, everyone always talks about if I had another chance at 2008, 2009, 2010, I would jump all over it, right? And the reality is, the last 12 to 18 months, may have been the best chance, since then, right? But when you're in it, it's a lot easier said than done, right? I mean, everything's harder, right? Lending is super hard, right? Equity is super hard. Finding deals is hard, right? There's a seller and buyer expectations, right? I mean, this last 18 months has been the hardest since I started in 2015, right? Yep. Everything's just taking longer, harder, a lot more kind of, it's a market, right? But I think the guys that are buying or in the game right now, like I said, as long as you have the right business plan, I don't think there's anything that's a 2-year flip, it has to be a long-term play, good real estate. And I think it's a great time to get in. And quite frankly, I've talked to like some family offices and stuff that have been on the sidelines for 10 years and they're right now gearing up to get in, and so that should be another indicator, right? And these guys have patient money. And so I think, so there's something to be said about that.
Yeah, definitely. So, it sounds like it's all about, adaptability and being able to pivot, that really kind of makes or breaks groups, right? Like there's no one size fits all, especially when it comes to different market dynamics, different asset classes. Can you kind of walk through an example where, Catalyst was able to, pivot, and really kind of recognize an emerging opportunity? Because it sounds like, you guys had the new construction, you guys pivoted from, Canada to the US, you pivoted from kind of C class all the way up to A class, kind of, curious as to kind of a case study where that really kind of turned out to your favor.
Yeah. No, I think those examples you mentioned are kind of key pivots that we made, and we're still making them. I think right now, right? I mean, we've put out 12 or 13 offers this year. Last year we did about 25 offers. So we were in the game. We haven't bought anything, but we were in the game. And I think one of the things that we've started to see is that, we've done deal by deal syndications to date, right? And obviously with those, they're, you get a specific deal and whatnot, and you get some home runs, but like if you got a few, deals that are struggling, there's no diversification to help you out, right? So one of the things that we're trying to do going forward, I wouldn't say it's a large fund, but we're trying to think of like buying deals as portfolios, right? And we couldn't do this like years ago when we started. We didn't really have a track record. But like now we're thinking, okay, maybe we could buy 2 or 3 deals, right? Different geographies, different vintages, and put them into like one portfolio, right? And that way, we're able to at least like, because look, like, I mean, we've bought, several deals post 2020, right? And most of them we've put on good debt. There's a few deals that we have some challenges on. And looking back, it's like if you see and Brookfield and all these guys are like, you'll see that, oh, they bought the deal for X and then they're selling it for X minus Y, but it doesn't impact them because they're in a fund, right? Because it could be the last deal in the fund, and they're still going to hit a 20 plus IR on the fund, right? Just basic fundamental, diversification principles. So we're trying to incorporate that on some deals so that we can, we may not have the home runs like we've had in the past, but you'll, at least insulate from downside risk, right? So that's one of the pivots that we're trying to make. And then, the other thing is, we're really looking at deals in some cases as 10-year holds, right? And so, I mean, it like we were 5-year holders before, and like 10-year holds right now, buying at good basis, let the supply work itself out. But that's not for everyone, like 10 years is a long time, right? But I think if most of our investors are patient and they're really not, I would say, not so focused on cash flow, because as the last couple of years, as pricing has gone up, cash flow has decreased, right? So I think if you have growth-oriented investors that want preservation of capital, buy at a good basis, work through these supply issues, 7 to 10 years from now, you should really see some upside. So those are those pivots. And then we've done a lot of things on our office, right? Like just like, an athlete in off season, right? There's the guys that go out and party and this and that, and they get back to a training camp and, they're huffing and puffing, right? And, we've done everything we can to, improve our back office, right? And there's a list of things that we've done. Our asset management is one of, the areas where I think we set ourselves apart, and we've added folks to that team, new investor portal. I mean, we're reviewing contracts deeply. So I think we're really kind of prepared to start, buying again and take advantage of this cycle.
Yep. And that was kind of the what I about a year ago is like, hey, during this downtime when things are a little bit volatile and stuff's hairy and there's investor hesitancy and people are sitting on the sidelines, now's a good time to actually work on the operations, build out your team, get your processes right, so you can really capitalize on the opportunity. It's about a year and a half out. Granted, I said that back a year ago, but curious with how kind of you've seen a lot of different markets, right? You've seen kind of markets that have gone up and to the right. You've seen markets that are kind of steady. You've seen kind of down cycles. Specifically when markets are volatile and there's a little bit more risk that's kind of in the game, what is your strategy? Is it to continue to be in the game and just to price offers right and kind of lowball offers where it makes sense? Is it kind of sit and kind of cherry pick the right opportunities for you? What's kind of your strategy when things are a little bit uncertain?
Yeah, I mean, I think if it's uncertain or not, I mean, we always have to have some type of, conviction of the future, right? But what we had is like our downside risk, no matter what, right? Whether we're buying deals at a 4.5 cap or a 7 cap, right? What is the downside risk on these deals, right? Some deals are 4.5 cap because, they're been owned for 20 years and rents haven't been touched, right? And we know with high conviction, we could take it to a 7 cap over 2 to 3 years, right? And so we try to look at our downside risk, right? And so that's number one, right? Base level cash flow, debt service coverage ratio, right? Do sensitivities on occupancy, right? I think, so those are like the basic things that we've done from day one. I think debt obviously is a huge component. Bridge loans and floating rate are bad words around, but I think people have taken it out of context, right? Like the reality is that floating rate and bridge loans have existed forever, right? But they were intended to serve a purpose, right? A bridge is from A to B, and a lot of guys were using the bridge loan, and it wasn't the right tool, right? They were stabilized deals with no value creation, and that's what we're kind of you're seeing a lot of people getting burned right now. That said, obviously interest rates have risen at an unprecedented level, but still, right? Like if you had created enough value, yeah, you may not have a cash out refinance, but you could have seen a path to potentially refinance, right? So I think the key is matching the business plan to the debt, right? And I don't want to say that, I mean, I'm still, for bridge loans if they make sense, right? But because a lot of people are like, oh, I'm just going to do fixed rate, right? But like, I have a great example that I had a fixed rate deal that I'm selling right now. And it was a 12-year deal that we originated in 2017, fixed at like 5.3%, right? But that deal, when the market was peaking in 21, and I have an original like less than $12 million loan.
Yeah.
When the market was peaking in 21, I had nearly a $4 million prepayment penalty, right? So people could say, oh, yeah, you got fixed rate, or you should have sold at that time, but $4 million prepayment penalty, right? So that was a mistake on our part because we did not match the debt with the business plan. If we had a 5-year hold, a 12-year loan was probably not the right thing to do, right?
Yeah.
In some ways, it's fine because, we had a fixed rate. We don't have those issues, but that's the whole key is matching the business plan to the debt and the execution, right? There's not one solution because a lot of guys are like, they go where fixed rate only, and then now floating only, or this and that. I mean, it really depends on the deal and your business plan.
Yeah, totally. Yeah, I've spoken with a few operators myself, and kind of similar sentiments. A lot of people they got burned by those bridge debts. Like, hey, I'm never touching a single bridge debt ever again. I'm like, I understand where you're coming from, but you're leaving a lot of kind of meat on the bone. You just have to be able to underwrite it appropriately, right? Like know what whatever it is, the rate caps, the future reserves, all that stuff that people I think failed to in their underwriting. You can use it appropriately, especially if rates are going to come down in the next 12 months. There's a good argument there that bridge debt might serve you well, but 100% correctly, you should use it for kind of a short-term business plan. But that's kind of what happened in 2022 when agency debt wasn't lending at high LTVs, and so all you pretty much had to make a deal work was that bridge debt. And that saying, if you have a hammer, everything looks like a nail. I feel
Yeah.
like people just kind of stuck bridge debt on whatever project, even if it wasn't the most kind of appropriate debt for that project.
Yep.
So there's a lot of market news and information and reports coming out. How does an investor really kind of filter out the noise and really kind of stay focused on that long-term investment strategy?
Yeah, that's a great question. I mean, look, the reality is like you said, especially with technology and advent of social media, you're gonna see a lot of chatter. You're gonna see a lot of people talking their own book,
Mhm.
and I think it's very important to be aware, right? But nothing beats kind of rolling your sleeves up, boots on the ground knowledge, right? So like we have subscriptions to Star and this and that we use for our underwriting. We use that data, right? But and that's why we've been focused on the markets that we're in because we know these markets very well, right? If we get a deal in Houston or Dallas, right, we can, within a day or two, really understand 90% of the deal, right? And so I think that's our competitive advantage. And, I mean, there's been times where, you see data from Houston, like, rent growth's negative, but all of our properties are up, And so I think that boots on the ground knowledge can't be replicated, And so that's how, we're aware of the general macro trends, right, which are undeniable. But then I think, right now, a lot of folks, the reality is there's a lot of group think, right? Like, there's like, hey, everyone thinks X, Y, and Z, and like that's like what 90% of the people follow, right? And so we just kind of look at our data internally, what we're seeing on the ground, and make localized kind of decisions based on that.
Yeah, yeah, super smart. Well, Shannon, I know the stories are very similar. The kind of strategies similar. If our audience wants to reach out to you, connect with you, what's the best way to do so?
Yeah, would be happy to chat with anybody. You can visit our website. It's cat equity, CAT equity.com. We've got a few resources over there, regarding multifamily and whatnot. And then I'm available via email, Shane, SHANE at catequity.com. And I'm also relatively active on LinkedIn. So you should be able to find me on LinkedIn as well.
Awesome. Appreciate it. Thanks so much.
Thanks, Nathan. Enjoyed it.
If you like this podcast, please hit subscribe or a thumbs up, and we'll see you next time.